Hey, welcome back. We're going through Instalco at the moment, a serial acquirer out of Sweden in the heating, ventilation, air conditioning, electrical sort of trade services. There are trade services roll up essentially. And we're going to go through their per share numbers right now. I'm going to then talk about some high level stuff. Then I'm going to go through a very strong negative thesis. And then I'm going to do a valuation factoring in all these different things that we've learned so far. Like I said in the previous episode, if you want to access Instalco through a broker, you're going to need one that can access the Swedish market. I use Interactive Brokers. That gives you access to these guys. So links in the description for them. All right, let's jump into the per share numbers. Because there's a little bit of dilution happening, and we can see that here, which says the average number of shares after dilution in the thousands. 5 years ago, it was 243, I'm going to say 243 million. I don't know if it's in thousands. Okay, yeah, so 243 million. Now it's 265 million. So it has gone up. It looks like at around about 2% per annum. And I know that that is for incentive purposes, they're not using that for growth. So there is a little bit of dilution happening. So I'd like to look at the numbers on a per share basis, and I'm really glad that they, in the annual report, put all this data out on per share numbers. So this is great. So first thing I want to see is the business as a whole growing, and the equity is growing. So it was 4.5 SEK per share. Now it's 12 SEK per share. That's some really good growth. But you got to remember, a lot of this is going to be tied up in goodwill because they're making acquisitions, and they're saying that, well, that acquisition could be sold for whatever price. Whether that's the case or not, I get a bit nervous about. Therefore, I'm not going to look at equity too much. It's nice to see it growing, but a lot of that's going to be tied up in that goodwill stuff, which is, a little bit on the difficult side to calculate. Now, I think a really important number here is the cash flow from operating activities, because essentially that's how we're going to work out free cash flow. But since this is such a really asset-light business, they don't really have any CapEx requirements. So cash flow from operating activities is just about their free cash flow per share. So this is awesome. We've got cash flow per share here. So at the moment, it's gone from 1.4 SEK per share to 2.7 SEK per share over the 5 years. So it's about a double. And what's that? 15% per annum. So that's good. So we've got some sort of growth rate over the past 5 years, over a pretty wild period as well. We've had COVID in that time. So we've had lockdowns and all sorts of distancing requirements and all sorts of things going on. We've also had a pretty rough period in the last 12 months with inflation and supply chain issues and things like that. So for them to be growing at 15% on a free cash flow level, that's good. We could probably use that when we're doing our valuation. Now, something I haven't talked about yet is the runway of this business. And I think it's actually, they've got a really, really big runway. There's 25,000 businesses apparently in the market that Instalco are chasing in the Scandinavian countries. And they have a tiny, tiny percentage of these. What's that? They got like 120 businesses or something out of 25,000. So there's no reason that this can't go on for multiple decades and just keep compounding away. I like that they're reinvesting even more than all of their free cash flow into acquisitions. Now, that might be quite aggressive, but if the returns are strong and that return on invested capital, return on capital employed number is good, I think they probably should be doing this, which is good to see. Now, on the other hand, we've got they're very tied to housing construction, and a slowdown in just the macro economy is going to hurt their businesses. In 2008 to 2010, the housing and constructing sector in the US fell 20%. So there is some risk there that this could fall at least 20% as well in like a pretty big downturn. Now, I've already mentioned that I'm really happy that the cash conversion is into free cash flow is really strong, and I like that that's a focus. I don't like that they're issuing shares, but it was actually 0% in last year, and on average, it's 2%. This I can deal with because it's for incentive purposes. So as long as they're not issuing shares to make acquisitions, I'm okay with that. The 30% dividend payout, I don't like that it's not very flexible, and they're already spending all their free cash flow on acquisitions. Why the 30% dividend? But I think they should just keep that money and let it compound and use it for lowering their debt or something like that. But this is not a deal breaker, as I've come to realize that a lot of people see the dividend as a kind of a risk mitigation measure, not just for the cash that they're receiving. It's essentially making sure that there's no fraudulent activity going on in the business if they're getting actual tangible cash out of it. They're getting this hard money from the business consistently. It makes you feel like, well, to actually receive the money, they have to be making the money. So I guess I can get on board with a low dividend policy. I don't know. I think we should be able to trust management more than that. But anyway, I can see why some people like a small dividend. Okay, now I want to put forward quite a strong negative element to this business that I found on Twitter from a guy called Hedgehog. So let's dive into that. Okay, so he starts by talking about how Instalco has grown at quite a fast pace, showing that their EBITDA margin is 7.9%. Both total sales and organic sales growth has been pretty strong, as you can see in this chart. Okay, cool. That is what we can see in this chart. And we can see the numbers of the last 12 months have been good. Instalco has deployed around 5 billion SEK in acquisitions, and with looks like around about 130 companies acquired, constituting on average enterprise value of 40 million SEK. It is worth mentioning that Instalco has a true decentralized model. Okay, we've talked about all those things. Regarding multiple pay, they're paying around 5 times EBIT, which is what we have already talked about. Bravida is another competitor in kind of the space in Sweden, and they're stating that after synergies, their multiples fall to around 3.5 to 4x, hence the good return on invested capital that Instalco are getting probably as well. Okay, now this is where things get a little bit interesting, I think. So if you look at his findings, my findings show that an aggregate level acquired companies under Instalco's ownership seem to continue to grow its top lines, but however, my findings show that the companies actually develop negatively on EBIT margins. So let's have a look at these. So from the acquisition year, some of the years worth of acquisition, so 2014 has been fine. 2015 has been relatively fine. But 16, 17, 18, EBIT margin has actually declined over those years. And that is quite negative. So he goes on to say that the acquisition companies have negative margin trend is interesting, considering that all Instalco's group EBITDA margin has actually been increasing since 2015. So this chart shows it kind of well, where the group EBITDA seems to be going up, but the cohort years actually seem to be trending down. So why the disparity? Well, because the development of some of these, like I said before in the previous video, there's a lot of things that can go on here in these businesses. So you can look here on this EBIT development. Some of them have done well, but a couple have gone down as well. So it is a bit all over the place. And according to Hedgehog and his findings, which I haven't been able to fact check yet, he says, my findings show that 73% of the acquired companies increase sales, but only 36% of them actually increase their EBIT. So their margins are generally going down more than, 36% of them are going up, and what's the other rest? 64% are going down. So the argument is that if the EBITDA margin that Instalco as a whole they're acquiring the increase in EBITDA margin, but a large chunk of the acquired companies actually decrease in profits, should they be getting a strong valuation premium on the stock market? And I think that's a pretty interesting point. So if value creation is low, why should a company that does not create value be valued higher than its invested capital? He says, I also believe that investors in general have focused too little on the actual value creation happening in the companies and too much on the group figures. He said, personally, I would like to see more companies displaying its organic EBITDA growth. And we're going to go have a look at the organic growth here in a moment. But it's interesting to see that if you go back in time, some of the cohorts have actually been performing pretty poorly. So all the acquisitions made in a particular year, that's what a cohort means. So then I went and had a look at what an analyst said about this as well regarding organic growth and annualized sale. But again, this is on Instalco wide rather than on the cohort specific level. But if you look at the organic growth per quarter, organic growth has been staying around about 5%, maybe higher single digits on average, but you do go through periods of pretty bad organic growth. Back in 2017, 2018, you had, looks like a really tough period. And when we looked at the numbers from Hedgehog that he was doing, he was really looking at the years from 2014 to 2018. So the negative margins could be associated with something going on a macro level in 2017, 2018. I don't know exactly, but I would really be interested to do a dig into the cohort level of 2014 all the way to 2023 and follow it along and follow them all through their period of time. It looks like they've just had a rough 2017, 2018 in terms of organic growth. And I think that could be why those numbers look like they do. And yeah, so there's still some more digging to do here. Just I need to raise that flag with you now. It's a yellow flag, not a red flag, but it requires a bit of work. Okay, so let's do a bit of a high-level checklist here. We've definitely got revenue growth. It's organic and inorganic for the past 5 years, has been really strong. We've got book value per share growth has gone from 3.37 SEK per share to 11.31 per share. That's 27% compound annual growth rate. Like I said, I don't really want to look at book value as much just because of the goodwill number. So earnings per share has grown at about 22% over that period of time. And that's factoring in the issuing of stock because it's on a per share number. We've got operating margins now at like 6-7%, which is a little down. We can probably justify that pretty easily with the increase of material costs and what's been happening with supply chains, blah, blah, blah. Return on invested capital is now at about 19%, which is still very good. And considering those declining margins, historically, this has been well above 20%. So it'll be interesting to see and important to see if this number goes back up. I think it can with margins returning to that target level. Debt is at 2.1 times. That's higher than I would like. I've said in the previous video, I prefer this under 2. I think higher debt is okay as long as the reliable revenues are really good. And I guess with that strong backlog that they have, they can justify having a little bit extra debt because they feel like it's really reliable revenue. I don't know whether it is that reliable personally. I don't know how comfortable I feel. I think having debt like this is a bit of a juggling act. I prefer it to be lower, but it's somewhere in the I'm probably going to be okay level, but under 2 would be better. Regarding free cash flow, they've been doing a really good job of converting the profit into cash flow, and that's been growing, which is good. Shares outstanding, we've seen a slight stock dilution for alignment reasons. It's about 2% on average per year. And incentives, now Per, he's the active chairman, and up until recently was the CEO. Now it's Robin. Pierre is still the largest shareholder. So as long as he is still there and involved, he's a very active chairman. I think that's good alignment. I haven't found the current CEO, Robin Bowman's remuneration package yet, so I don't quite know whether his incentives are aligned. My guess would be they are, but I haven't checked that yet. So maybe check that one if you're wanting to dig a bit further into this. Okay, now I know I said I was going to get to a valuation and a summary, but this video's already gone on long enough. Let me save it for tomorrow. Plus, I kind of want to tweak my valuation model a little bit that I have in front of me here. So give me a day and I'll get back to you on that. So I'll pick this up again tomorrow and I'll see you then.